Diahanna is the financial program manager, and she specializes in financial help for people with multiple myeloma and AML. As a professional financial advisor and former caregiver of her husband who was diagnosed with multiple myeloma, she understands perfectly the financial issues that are facing cancer patients. And not only does she understand them, but she is willing to dedicate her education, her time, and her skills in order to make sure we are receiving the best education possible when it comes to these financial issues. Today, we're going to be talking about preparing your 2022 tax filing. So goodbye to 2022, whether it was a good year or a poor year, we're into a new year. And now we got to think about filing our taxes for 2022. This is going to get complicated due to medical bills and other myeloma expenses. So today, Diane is going to share general advice with us while also giving us suggestions to talk to our professional tax accountant about. So with that being said, Diahanna, I'm excited to hear from you, and we'll get started.
Oh, thanks, Audrey. It feels like I've been away for so long sitting in this seat, but thank you for everybody who decided they were going to participate in this. I hope that everyone can get a nugget of information that's going to help you on your taxes and possibly bring some more money to your pocket. So again, I want to reiterate that this is general information. I'm not a tax professional. I'm not a accountant. I would suggest if there's any specific things you need to have addressed, reach out to them. They are very willing. I also want to be, if I didn't put this in the slides, I will also want to make sure that people who have low incomes or disabled, they can get free filings on your taxes. So be aware of that. There's a lot of opportunities that are out there for people, but I want you to make sure you take advantage of all of them. So these are the things we're going to cover in this webinar. So we're going to get everything together and get organized. Getting your documents together now, the first 1 or 2 weeks is going to help you file those things in a timely manner and as seamless as possible. There are still, hard to believe, there are still people who are still waiting to get their refunds back from 2021. Everything's been bogged down. Evidently, there's going to be an $80 million refit or retro in the IRS department. We'll see how that goes. They've been saying that for years. Their system's very antiquated, but the more that you do to protect, to pull everything together, protect your paperwork, protect everything that you have going with your tax filing and getting those things organized and expediently, the better off you're going to be. So we're going to review the current 2022 important facts. Things have changed now, and it's going to be changing for next year. So I want you to prepare not only for taking care of 2022 taxes, but prepare going forward for 2023, things you can do now to put into a place so that you can be better prepared for next year. And we're also going to understand what needs to be gathered and or changed for next year's preparation. I'm only going to review some of the pertinent information to you guys, things like Audrey mentioned, tax credits, changes for the cost for, or what benefits you can get for your patient assistance programs. We're going to go through all those things. So let's get all this together. Again, talk to your tax professional for personal questions or concerns, because I can't cover all those things. Next slide. So the documents you're going to need are your 1099s, and there are quite a few 1099s, your last year tax returns, your W-2s, proof of medical related expenses, paid out of pocket, insurance documentation, especially for affordable care or Obama plans, health insurance marketplace statement form, or your 1095A. Audrey, do we have the notes on here? My slide notes?
You won't be able to see. Do you want me to read them? You won't be able to see them.
Oh gosh, I won't be able to
Remember?
see them. Well, yeah, I need to be able to see those. Because I didn't print them off over here. Could you go over the different 1099s? Because I think it's very important. A lot of people forget or don't understand what those 1099s are, and it's going to relate to probably some of them for everybody in this audience.
Yes. So there's 1099 or NEC, 1099 DIV or DIV, dividends and distributions, 1099 INT, interest income, 1099 MIS, like miscellaneous income, 1099R, which is distributions from pensions, annuities, retirement or profit sharing plans, insurance contracts, etc. 1099C, which is cancellation of debt. 1099B, which is proceeds from broker and barter exchange transactions. 1099A, acquisition or abandonment of secured property. 1099H, health coverage tax credit, HCTC advance payments. 1099G, which is certain government payments like unemployment compensation, state and local income tax refunds, agricultural payments, and taxable grants. 1099 LYC, long-term care and accelerated death benefits. 1099 OID, original issue discount. 1099Q, payments from qualified educational programs under sections 529 and 530. 1099 SA, which is distributions from an HSA, Archer MSA, or Medical Advantage MSA. I'm going to copy that and put that in the chat so that people can see that if they need to.
Right. So a lot of those things are very pertinent, like the last one, the Archer, the MSA programs. If you've got unemployment for this past year, there's a lot of things in there. I think you really need to pay attention. If you took advantage of any of those programs or had unemployment, make sure you get those 1099s, because if they're not filed correctly, and because when you got that income, it was filed in your behalf, or they sent something there. So they're waiting for those documents to match up. Make sure you do that, or you may be audited. Don't want you to get a surprise in the mail.
Yeah, thank you. Diana, can you move your microphone? Do you have your microphone plugged in? Could you move it a little bit closer to you? Some people are having a hard time hearing you.
Is this better?
Get it a little closer.
Oh, I'll be off the table at that point.
Oh,
How's this? Is this any better?
I think it's a little bit better. If the audience can let me know if that's good, that would be really helpful. And we do have captions available if people want to turn those on.
I'm going to switch to a different outlet, see if it works.
Okay.
Better. How is this? I mean, without it, is that okay?
Yeah, I almost hear you better.
Okay, well, let's do it without. And if I need to change, let me know.
Yeah, let us know to the audience.
Okay. Next slide. Other documents you're going to need is your social security numbers for you, your spouse, and dependent children, or other dependents. The other dependents would be if you filed on behalf or claimed a mother, a grandparent, or anybody that you're taking care of. You need to have their social security numbers as well. Forms of any taxable unemployment income, such as your unemployment for being off, or disability income, but where you had to pay taxes and you're maybe not at your job anymore, things like that. You need to really pull those papers together. And all receipts for deductible itemization items if you're going to itemize. But I'm going to say this again later on in the webinar. You cannot use any kind of income that you received for copays, deductibles, deductibles for your insurance, if you received reimbursement for that through your nonprofits like your Leukemia Lymphoma Society, HealthWell, because it just doesn't work that way. Anything above and beyond what you paid out of pocket that you were not refunded or given money back for, then you can claim that if it's above 7.5%. I would suggest you go to all of, right now, I would go to your CVS pharmacies, all of the pharmacies you use for any of your medications, not just myeloma, anything for out of pocket for your copays, deductibles, premiums as well, healthcare insurance premiums that were not refunded to you through like LLS. All of these things you pay for, and think about those things that maybe you had to go a trip out of town to see your specialist. All of those things you can itemize. As much as you can itemize above that and get above that 7.5% that you can't write off. You have to go above 7.5%. Get all those documents because you're going to need those receipts in the event you get audited later on. Next slide. So understanding your AGI or adjusted gross income. This is very important if you're going to be putting in applications through your nonprofits like Leukemia Lymphoma Society, HealthWell, because they're going to ask you for this AGI. Keep in mind, your AGI from last year may be different from the AGI you're anticipating this year. Let them know that, because that can make a difference in whether you're going to be accepted in that grant. So when you're applying for some grants, you may be asked about your adjusted gross income. You'll find that on your tax statements. That's why I suggest you look for your last year's tax returns. It will affect your taxes. AGI is your income from all sources minus any adjustments. Generally, the higher your adjusted gross income, the more taxes you'll pay. Good tax planning can include making changes during the year that can lower your AGI, changing your number of deductions or people you claim. There are several ways you can lower your AGI, including contributing to a retirement account like an IRA or 401k. And I want to mention right now, what you can contribute has gone up for 2022, 2023. So, and especially if you're over age 50, you can still do that additional $1,000. We're going to go over some of those changes at the end of the webinar, but that's a way to reduce your tax liability. And surprisingly, sometimes when you make increase your contributions to your 401k, you may find more money in your paycheck. So there's something for you to look at because you're paying less taxes. So also, if you're contributing to a health savings account, that also makes a difference in your taxes. Next slide. So again, life events also affect your taxes. Purchasing a home, how does that make a difference? If you purchase a home, no matter what time of the year you had to pay upfront interest. So look at that. You can write the interest off. You can itemize that interest. That's almost the only thing you can do anymore for on a home. Losing a job, if you end up paying or received your loss of income, or if you received unemployment benefits, that's going to affect your taxes. A loss of income can actually reduce what your tax liability is, of course, because you don't have that income coming in. Going to college, you can reduce and use some of the tax advantage programs for college, for people who are going to college that you claim as dependents. Getting married or divorced, getting married, you now from single, filing a single person, you're now filing as a married. That increases your deduction, your normal deduction. Or if you're divorced, that can change as well. The birth of a child, you have another dependent, which actually increases reduces your tax liability. The death of a spouse, child, or dependent can also affect your adjusted gross income. So I would suggest you look at everything. If you change how you're paying for your medical insurance, if you change how you're paying for long-term care, because you can also write off some qualified long-term care premiums as well. Take everything into account. It's going to be better for you on your taxes. Next slide. So additional things, understanding your adjusted gross income. Tax credits for earned income tax credit. We're going to break that down as to what that means. Child and dependent care credits, child tax credits, credits for other dependents like your grandmother or people like that. Education credits, we kind of went through that. So properly claiming these tax credits can reduce taxes owed and boost your refunds. If you don't want refunds, and here's a lot of things people say, I really look forward to that check every year because I know I'm going to get a refund. It's a good way to save or anticipate a saving if you've done everything correctly. However, if that's money you need to pay for medications, why are you letting the government hold your money? You might want to see if there's ways so you can go in and pay the taxes that you're due and not have your government holding your money that you have to wait a whole year to get. So take all that in consideration. Your tax accountant can help you figure those numbers out. So always keep records that show your eligibility for credits that you claim. This would also include agency letters about advanced credit payments you received, like advanced child care credits, and those things are going away. And there's going to be people who are going to get bills for increased taxes as a result of some of these things. Your next slide. So charitable deductions. If you donate to charity, you may be able to get a tax deduction or credit. So tax deductions can help you lower the amount of income that you're actually taxed. Some of these are only available if you itemize deductions, so be aware of that. You want to itemize if your deductions are going to be, your itemized deductions are going to be higher than your standard deductions for single or filing married. Other tax deductions may still be available if you take your standard deduction, like writing off your mortgage insurance, your mortgage interest. Next slide. I want to talk a little bit I want to talk a little bit more about the charity thing. We all give, or hopefully we all give if we're able to for charity. And hopefully everybody looks at HealthTree and they're getting a benefit out of that, and they can donate to HealthTree, which I always encourage if you're able to do so. But there's a way to actually give more than what you're giving on like a $10 or $20 as well. People aren't aware there's gifting that you can give to a nonprofit, such as um, maybe art or benefits of a life insurance policy or highly appreciated stock, which you're never going to use. And you can get those tax benefits while you're living. So there's a lot of things that you can do to reduce your tax liability, but you can also give towards your favorite charity. So now, understanding some of the tax extensions. Tax credits that we mentioned earlier are actually dollar amounts that are subtracted from your tax bill. There are two types of tax credits. Refundable, and that's when the tax credit is greater than the amount of tax you owe. You get the difference in a refund. We understand what that's like. You get a, you pay $2,000 in taxes. Unfortunately, it's a whole lot higher than that. But what you're required to pay up maybe only $1,500. So you get that $500 in a refund. Non-refundable tax credit is when the tax credit is non-refundable, even if the credit is higher than what you owe. Your tax bill will be reduced to zero. However, you will not get a refund. Those are kind of hard to wrap your head around because you're paying taxes and you pay more. Why can you not get a refund? So it doesn't reduce your tax bill. Next slide. Again, charitable deductions. Extended from the Taxpayer Certainty and Disaster Relief Act of 2020 and through CARES Act for those who give to charitable organizations. This allows you to deduct up to 100% of your adjusted gross income in qualified charitable deductions. However, you must itemize your deductions. Very few people, I think, actually can deduct up to 100% of their adjusted gross income. If you take your standard deduction, you can get an above the line deduction on top of your standard deduction for donations made in cash. So if you pay cash every month or whatever to your charitable donation, even if it's taken out of your checking account, that's considered cash, then you can deduct that those donations. So for those who make cash deductions to HealthTree and cash, this is an opportunity for you. Be aware of the maximums though. So you can, if you put in $100,000 or $200,000, you got to be aware of what those cash deductions are going to do to your taxes. Again, see your tax advisor. Next slide. So medical deduction, this is what's going to make the most impact, I think, on the people who are listening today. So you can, again, I am reiterating some of the things we spoke about earlier. So you can deduct medical expenses, premiums, copays, deductibles, all out-of-pocket medical expenses above 7.5% of your adjusted gross, not your gross income. I've had people look at their gross income and not file. Don't look at your gross income, look at your adjusted gross income on that, please. You must itemize your deductions in order to realize these types of deductions. So, which means for every receipt you have, you need to itemize those things in categories on your tax return. Contact your pharmacy again for a printout of all that you paid towards your prescriptions and get a printout of all the copays and deductibles paid for doctor's visits. Your doctor's office can provide those things to you. You may be able to find it on My Chart. Save yourself some steps and some time. But make sure you include all of those things. If you went out of town to visit, if you had a strange bill that came through that you paid out of pocket, make sure you include all of those things. Get a printout of your insurance premiums that you paid as well. Did you spend money on other items for home modifications for medical needs? Those things can be included. Did you have to get things for like anything done to your home, like you had to do pull bars or ramps to your house? All of these things that you paid for out of pocket for medical needs, or had your car changed for a wheelchair or for operation, all of these things can be tax deductible. So all of this will count. Again, you'll have to itemize your deductions in order to write off these expenses, but it's well worth looking into. Next slide. So any assistance you receive from patient assistance programs, again, or from nonprofits, do not apply towards your deductibles, which means you cannot write those off your taxes. You got to reduce the amount you receive from these patient assistance programs from your line items, and then what's left over is what you can deduct above the 7.5% of your adjusted gross income. Next slide. So for those who receive grants from your pharmaceutical companies, like patient assistance programs through, let's say, GSK, to help pay for prescriptions, know that you do not have to file this financial assistance on your taxes. You don't have to claim that. Also, if you receive grants from nonprofit organizations for copays, deductibles, or any other medical assistance, you don't need to file this on your taxes. However, again, you need to reduce it from your 7.5% if you're going to be itemizing some of these deductions. Next slide. So here's an area that it's unfortunate, but a lot of people forget about this. Don't forget to see if you qualify for this tax credit. That's the earned income tax credit. 1 out of 5 taxpayers who qualify either don't claim the benefit or don't file a tax return. This tax credit is designed to help out lower or middle income households. In order to qualify, single filers must have adjusted gross income below $16,480, while the cap for married couples with 3 or more children is $59,187. So if you are on Medicaid, this might be something you might want to look at because you probably already qualify for that. So please look at it. And so you can take advantage of this earned income tax credit. Depending on your filing status, the credit could save you anywhere from a few hundred to a few thousand on your taxes. Well worth the time. Don't forget to see if you qualify. Next slide. So let's discuss some of the post-pandemic tax implications for 2022. And I got a feeling some of those things are going to go over to 2023 as well. So if you lost your job and received unemployment insurance benefits in 2020, the first $10,000 of your benefit was tax-free. And that's in 2020. So that's when you filed your 2021 taxes. However, in 2021 and 2022 filing taxes years, if you were unemployed and did not have taxes withheld from your benefits, you will now have to pay taxes of those benefits. Make sure that you get a copy of those forms 1099, I can't remember those I think, whatever those 1099 forms you make sure you get that when you file your taxes, or else you might be audited later on, or you'll get a really big tax bill with penalties and interest associated with it. You don't want that to happen. Next slide. So there's some changes to 401k plans, IRAs, and more. So for 2021, some of these changes can impact your 2022 tax bill and possibly 2023. The required minimum distribution age, those are for people who are now age 70 and a half. You're required to take money by federal law out of your retirement plans, anything that was tax deferred. So the retirement age went up. It's no longer 70 and a half. Now it's 72. So you can defer taking money out if you don't need it out of your retirement plans, 401ks, IRAs, whether not necessarily IRA, all the IRAs, the ones that went in before taxes, you do, but after taxes, you don't. But your required minimum distributions went up to age 72. So you don't have to take money if you don't need it, which means less money unless you have to file toward your taxes. For those who have beneficiary IRAs, the rules can be more complicated. So if you are a spouse, you could have turned that IRA into your own IRA. If you are children of a decedent or someone who died, then you had to follow different rules with your IRA, especially if that person was already taking money from their IRA. So I suggest you refer to your tax professional for help regarding your specific situation, or also talk to your financial advisor because they should know what these rules are. If you don't need the money, if you don't want to pay the taxes, don't take it out. That will give it an opportunity to grow when the market starts rebounding. And a lot of times the markets rebound fairly well. So I know right now is a tight time for inflation. Inflation is eating every dollar up, including your savings. So if you don't have to go in there and get it right now, don't. Next slide. So the premium tax credit, or PTC, is a refundable credit that helps eligible individuals and families cover premiums for their health insurance purchased through the health insurance marketplace. So for Affordable Care Act or Obama insurance. In order to qualify for this credit, you must meet certain requirements. The American Rescue Act of 2021 temporarily expanded eligibility for the premium tax credit by eliminating the rule that a taxpayer with household income above 400% of the federal poverty level line cannot qualify for a premium tax credit. So again, please consult with your tax professional for the criteria or eligibility. It's really simple to find a lot of this information out. Go to irs.gov and it'll give you a lot of the information here if you have any questions. Next slide. The Volunteer Income Tax Assistance Act offers free tax help for people who generally make $54,000 or less. So that can apply to a lot of people on this call, or persons with disabilities. The elderly and limited English speaking taxpayers who need assistance in preparing their own tax returns. There are IRS certified volunteers who provide free basic income tax return preparation with electronic filing to qualify for individuals. And I also suggest file electronically if you can, which means you're going to need a bank account, you're going to need your email account, you're going to need all these things. If you're elderly and don't have those, you need the help filling some of these things out. Call them. They'll help. They'll assist you with getting this done. Because if you file electronically, it's going to go through faster versus doing paper. And paper is becoming a lot more um, not secure, I should say. So be aware of the security when filing paper returns. You can access this assistance at community and neighborhood centers. Call your local library. They'll have information about this as well. Schools, shopping malls, and other convenient locations. That's going to be really taking off here soon. So the sooner you get your paperwork, your everything together, the better it's going to be for you. If you anticipate returns, the faster you're going to get your returns back. Next slide. So out-of-pocket expenses and the Affordable Care Act. The Affordable Care Act offers premium tax credits to help with a portion or all of your out-of-pocket expenses depending on your income. This credit helps individuals and families with moderate to low incomes who purchase health insurance through the health insurance marketplace. You must file a tax return to establish your income. So you can do ACA if you're on a low income. If you do not file your income tax, you're not going to get this tax credit. Costs incurred by using non-network or out-of-network providers as determined by your plan are not eligible to be covered as out-of-pocket expenses. So be aware of all of this when you're looking at this premium tax credit. It is an advantage to those people who have moderate income to take advantage of all of the credits that you can get. Next slide. There is a cap on out-of-pocket expenses. There's a limit set on the amount of money you spend to maintain your health insurance plan through the marketplace. Deductible or co-pays or maximum out-of-pocket is what we're meaning by what you need to spend. After you reach this amount, the insurance company is required to pay 100% of any additional costs for that year. So for people who don't understand the ACA, and I have to repeat this because I'm surprised a lot of people don't know, you do not have to be a low income, uninsured person to sign up for ACA. In fact, you could be working, and we're talking about people who are under 65 who are not Medicare eligible or government medical plan eligible. So you could be working at your job and have your employer insurance. Your family can sign up for ACA because the cost of insurance for employer plans are extremely high. But if you can go to ACA for your spouse or children, it may be a lot less expensive. There's also a limit on the out-of-pocket costs for high deductible plans for the marketplace. So high deductible plans have where you can also participate in health savings accounts, MSAs. So I would take advantage of any kind of savings account to pay for out-of-pocket costs. And you can also realize the cost of your premiums can be taken care of. Be aware of ACA and the opportunities you have through the Affordable Care Act, or known as Obamacare. Next slide. So let's review this. It's a lot. Again, go to your financial advisor, talk to your CPA. They can walk you through a lot of these things. If you don't have time to do that, just start Googling. You have time to look at irs.org. There's a lot of information. You can just say information about tax changes. You're going to get a lot of that information, not just for now, but for 2023. And prepare for 2023. Look at your W-2s. Do you need to change your exemptions on that? Look at things that you could do. Can you save a little bit more on your W-2 that will go towards your taxes if you have a high tax bill at the end of the year? If you need to look at more exemptions or look at more deductions, try to find out a way to reduce your tax liability. If it means you saving more that's going to benefit you down the road in your 401ks or your IRAs, look at those options as well. So many of the tax extensions from the CARES Act have been extended. Thank God. We don't know how long there's going to happen. They're going to stay that way. The effect of the CARES Act may have tax liabilities that will now become due if you have some extensions that went through that you took credits for and your income's changed or other things have changed. You may have taxes that may become due. Tax credits should be reviewed so you can get the most from them, always. If you're disabled or low income or low to middle income range, be sure to review the options. I apologize, I'm having a hard time speaking today. If you are disabled or in the lower to middle income range, be sure to review the options that are available to you. Again, you can get free tax help and for the low to middle income or disabled if you need to have that done. Please seek the help from a tax professional. I would encourage everyone to start pulling your papers, all of your receipts for travel, for lodging, for food if you had to go out of town, because you can write some of that off, as well as your prescriptions from everywhere you got them for wherever you got your scans, bone scans, blood work, everywhere you got your check or your credit card. You can get receipt. You can actually get a printout from your credit card company and try to find out where all of those documents are, because the more you realize in these deductions, the better off you're going to be on your taxes. So I think that comes to the end of it. I know that was kind of fast. There's a lot of options available for you. There's a lot of help out there. I will be glad to answer any questions. I didn't go over everything, but there's a lot. As everybody knows, it's a lot. And if you're on Medicare, there's a lot more for you to consider and to be aware of.
Definitely. Thank you, Diana.
Mhm.
Something Diana and I discussed is this year trying to have more open Q&As. So in addition to her excellent information that she gives, giving you guys opportunities to have full hour sessions where you can come and ask your general financial questions about myeloma. The reason why I bring that up is your questions matter so much to us, and they help us understand what your needs are and what really you're looking for. And we always are going to have a question and answer as a part of every topic session, but we also hope to have open Q&As. So with that being said, now it's time for your questions. And as Diana said, she's more than happy to answer the questions to the best of her ability or help you form a question that you can bring to a professional tax accountant. So the first question that I see here, Diana, is what is the amount number for the federal poverty limit? What is that dollar number?
And it's going to depend that it's not just a number. It depends on how many people are in your household. So there is a single, and it's a different amount for each additional number of people in your household. You can go to federal poverty levels and just what are the federal poverty levels? Google that, and it'll give you all the information you need.
Okay, thank you.
And that's standard across every state. It doesn't change.
Okay. So somebody wanted to clarify. So patient assistance programs and assistance grants, like you can get, for example, from LLS.org, are not taxable income. Is that correct?
That is correct.
Okay, that's really good to know. But the trick is you can't use that towards your 7.5. Explain the 7.5 one more time for people that joined late, because I see some questions about that.
Okay, let's say you had 100 your growth adjusted. You hold these easy numbers for understanding. Your adjusted gross income, not your gross income. Your adjusted gross income is $100,000. You have to. The baseline is $7,500 out of pocket that you cannot claim. Anything above that $7,500, you can claim on your taxes. You can itemize that.
Okay.
Hope that helps.
I think it does. Thank you. Okay, so are over-the-counter medications tax deductible?
Depends on what those over-the-counter medications are. Generally, yes, if you keep receipts for those things, and it's for like you can get some of the vitamins that you get. Sometimes the doctor will give you a prescription for, let's say, vitamin D3, maybe 50,000 micrograms a month.
Dollars. I was like, wow.
No, I'm sorry. Micrograms a month, and you can get vitamin D3 over the counter, And you can still write that, off, because those are things your doctor says you need.
Right.
And if you need bandages, uh, things that you get for like needles, syringes, things that you pay out of pocket for, like for diabetes or for neuropathy, things like that. Yes, you can write that stuff off.
Wonderful. Okay, couple questions here about mileage for volunteer work. Is it still deductible at 14 cents per mile?
It has actually gone up 3 cents. So
Okay,
your
so
mileage is,
17
going
cents.
up. Mileage for those things are going up, as well as mileage for business deductions. Those are going up as well, 3 cents.
Okay, so I'm gonna put it's, oh, whoops. Robin, I'm sorry, I'm gonna type that in. So it's 17 cents per mile. Just for people that are curious.
Yeah, make sure when you're doing those kind of things, I think this is the hardest area, I think, for people to keep their receipts on, is when you're doing mileage. And if you're buying gas and things like that, if you
Mm-hmm.
use, keep your receipts. And when you get those receipts, those things, they fade out really quickly. Or you can take pictures of your mileage in your car. There's things you can do to keep those things up. There's also something you can, I think there's a almost like a pedometer or something you put in your car when you do trips like this for a volunteer. But keep a copy of those receipts. And if you get a regular receipt, or you go to a place, they say, we're going to sign off on your mileage, make sure you make a copy of that, because those other receipts will fade and you will not, within a year, if you keep it in your car. And I keep a lot of things in my center console, they are ineligible. Can't read them. They're gone. It's terrible. So you got to keep up with those receipts.
Yeah, definitely. So clarify a little bit what it means by volunteer driving.
Okay, so if you are going from, let's say, from your home, and you volunteer, you run the local myeloma chapter support group, or you are going to the hospital to help patients, as a, that is considered volunteer, as long as it's a qualified volunteer, qualified program that you're volunteering for.
So if it's driving somebody to a stem cell transplant, that's not counting as volunteer driving.
It may not be. I would talk to your financial advisor.
Okay. Thank you. Um, is medical travel deductible at all?
If you keep the receipts for those, medical travel is deductible. Keep a copy of your gas, room and board, food for one person, not necessarily for both people. Keep a copy of all those things. It is deductible. That is a cost for your health. Yes.
Wonderful. Okay, so this person is wondering, they didn't have an FSA, HSA, or HRA for dental expenses. Can they include this type of expenses dental in the deductions?
If they paid out of pocket for those things, is that what we're saying?
Mm-hmm.
Yes, you can. That's
Okay, yeah.
still medical. People forget. Glasses, dental work, vision, all this stuff is
Mm-hmm.
medical expenses. Yes.
Wonderful. Okay, somebody's asking if there's work that they used to do around their house and can no longer do that work because of physical limitations due to myeloma. They have to hire to get the work completed. Is that work deductible if they pay out of
Unfortunately,
pocket?
it is not.
Yeah, dang. Okay, so the question here is, what is the maximum adjusted gross income threshold to qualify for medical expense deductions? And how can it be itemized and deducted knowing that the baseline is 75,000 when the maximum able to be deducted, such as the cost of a stem cell transplant?
That's very complicated.
I know. Can you open if you don't mind clicking the question and answers yourself that you can see at the bottom? And it's Tim's question. And Tim, maybe if you want to re-ask that question. The baseline isn't actually 7,500. Diana was giving an example,
Yeah,
just to be clear.
right. That's 7,500. That's only based on, yeah, if you had $100,000 adjusted gross income. 7.5% is you had to go above 7.5% of your adjusted gross income before you can claim anything.
Yeah, it's your personal adjusted
Adjusted
gross
gross.
income, 7.5% of that. We used 7,500 as an example because it's easier math. Okay, so Tim, if that didn't answer your question, if you could ask it again, we would be more than happy to try our best to answer the question. Jen is wondering do you know if medical mileage rates for the first half of 2022 was 0.18 and increased to 0.22 for the second half of the year?
I'm not sure about that, but I think the mileage rates increased for everything across the board. I will check and we'll put that on with the other information.
Okay, yeah, we'll definitely look into that. That's a great question. It really does get complicated, we were talking before the session started, Diana and I were talking about, when is that point when you go, somebody else should really do my taxes for me. And, she brought up the point that it really becomes on how much, you itemize in terms of if you're going to be itemizing a lot of things, then that's really advantageous to have somebody in your corner making sure that you're getting the maximum refund or tax credits or whatever it may be to make sure that you're not paying more than you need to.
Right, right. And remember,
Yeah.
I was talking about the retirement limitations that went up. And if you put more in your retirement plan, you may end up realizing more in your check. I want to go over this a little bit more. So Americans contribute up to $22,500 in your 401k. It used to be 20,500. So there's an increase in that of $2,000.
Okay.
For 2022. So if you went up, you can it's actually better for you. So meanwhile,
and is that per year, Diana?
Mm-hmm.
Okay.
In 401ks and 403bs and 457. So 457 is usually people who work in hospitals or things like that. Meanwhile, the limit on annual contributions to an IRA, like your individual IRA, you go to the bank and you had an IRA, increased to $6,500. It's up from $6,000. And so if you're 50 years old or older, you still have $1,000 additional to that you could put in every year. So the more you put into your savings, and I'm telling you now, a lot of people, when the market goes down, they do not save. They say, well, the market's down, I'm not going to make anything. You put it in now, you're buying everything at a discount. Everybody wants to get a discount. You don't want to pay a premium. You don't want to wait till your car that you want to buy is $50,000 more than it was when it was last year. Buy it when it's cheap. If you have money that you can afford to put into your 401k, put into your IRA, I would suggest you do that, because when the market starts going up, you're going to see that increase even more significantly. Markets use, and I say this, historically, when the markets start improving, we have seen some years when the market improved in a year 30, 31%. Where else are you going to get that? If you didn't have the money in there to get that 30, 31%, you've lost that opportunity, right?
Mm-hmm.
So now in Roth IRAs and your savers credits all increased in 2023. So be aware of what your savings contributions are going to be. In addition to that, income tax rates, your marginal tax rates have changed. So if you had an income that was where your tax rate was like 25, 26%, it may now be 24%. 2% lower, which means you pay 2% less tax liability, can be huge for some people. Where you didn't get a tax return, you may now realize a tax return. So that's for everybody. I would suggest you look at your tax rates and talk to your financial advisor. So standard deductions. If you don't itemize, standard deductions went up. For an individual person, it was $13,850. That's up $900. And for the married couples, it changed as well. It went from $27,700. It went up to $27,700. It's an $1,800 increase. So that means you're realizing a better tax return. So I would suggest you look at that for flexible spending accounts, that if you have health insurance and you want to set aside money to pay for those copays, deductibles, things out of pocket, I would suggest you look at those things. Those went up from 3,000 went up to 3,050 from 2,850 from 2022. So that's for your 2023 contributions. Take advantage of that. If you find yourself paying out of pocket, why not use that? It comes out pre-tax, a benefit to you. And you get to take that money and pay for things down the road you're going to pay for. A lot of people don't realize too, for flexible spending accounts that you have set aside out of your check to pay for out-of-pocket expenses, if you only put in there for the first 2 months out of your paycheck, and it's automatically taken out of your paycheck pre-tax, you can still use that entire benefit for the entire year up front. You don't have to wait until you put it into your account to realize to be able to take it out and use it for expenses. So be aware of that opportunity is available to you.
Awesome. Thank you. We have somebody saying people can also lower adjusted gross income by maxing out or contributing to an HSA for high deductible plans.
Exactly.
There's so many tips and tricks.
There are.
Can Medicare recipients qualify for any kind of health savings plan?
I'm sorry.
Can Medicare recipients qualify for any type of health savings plan?
They can. There's an MSA account, and again, you got to look at whether you have in a high deductible plan or not. But I would suggest you get on Medicare.gov and look for those options.
Great. Okay, and then Tim is re-asking, is there a maximum cutoff for adjusted gross income to qualify for itemized medical expenses?
None that I'm aware of. No, I've known people who had $500,000 adjusted gross, and they had a huge medical bills, and they were able to realize some of that that deduction.
Great. Fernando's wondering, I've been paying for storage. Can I deduct this type of expense in the 1040 and 540? He mentions 540 because he's in California.
Not unless that storage was used for a business expense.
Okay. There's so many things that it's just like, oh my gosh, can't they make this more simple?
No,
That's
they
my
can't.
no, they can't. Oh, well, I'm so glad, Diana, that we have people like you and that we have professional tax professionals, or that was a reiteration, but that we have people that are willing to help us and that can guide us, because it is so tricky and it does get complicated by myeloma. We have about 5 more minutes for questions and then we'll finish up. So if you want to ask your question, make sure you get it in right now. Luce is wondering, when and how are taxes paid for flexible spending accounts if they are pre-taxed?
Okay, it's almost like you take your 401k out. If it's pre-tax, this is a benefit that the federal government gives you because it helps them on taxes. So if you have your flexible spending account and you have money taken out, let's say $400, then a year, then you don't, your benefit is you're not paying taxes on that. And then you're paying that to the doctor for whatever out-of-pocket expenses. So it's a benefit for you.
That money never does get taxed. It's able to pass through, not straight to the doctor, but it's able to go to the doctor without being taxed by the government. Is that correct?
That is how it runs. Now, if you don't use that money though,
it disappears. Yeah, it's awful.
You lose it.
Where does it go? Do you know?
It stays with the company who took it out of your check.
Yeah.
So when do you need to set up a HSA? By when? I want to say.
Let me just reiterate the questions for people that can't read it.
Okay.
So the question is, by when do you need to set up an HSA for this year? HSA is health savings account. Mm-hmm.
It depends. If you're mid-year and you got a job, or even if you're in the last part of the year and you got a job and you're eligible to sign up for HSA, you can do it. And you can go to your bank. You don't necessarily have to. There's a lot of places that set up health savings accounts for people. And remember, this is a great benefit, health savings accounts, because you can use that money if you don't need it for health, for retirement, supplement retirement and things later. So there's a great opportunity for health savings accounts if you're in a high deductible plan and you don't use all that money. It doesn't go away like regular health,
like flexible
spending accounts. So you can go to, there's somebody said best health savings account is at Fidelity Investments. All the others nickel and dime you. Matter of opinion, because I've set those up for people. I've looked at them and I have to do that on the financial advisor side. It depends on what your needs are.
Yeah.
How are you going to be using it?
Yep. We're so glad you found something that worked for you and want to share it with other people. And it's really just trying to figure out, what do you need it for? What's best for you? What's offered to you? And then trying to figure it out along the way. Well, thank you to everyone for participating, for joining us. It really is a pleasure to get back in the swing of things. I know there were a couple bumps along the way. And then there's also somebody that put in many resources to find the best HSA for you. So this is super helpful. And I'll keep that up during my, so that you guys can see it in the answered questions. So it is a link that says millennialmoney.com, and we'll take that as well, and look at it. And if it's deemed a good resource, then we'll share it with the rest. We just always have to vet our resources before we share them with everyone. But thank you for sharing your information as the audience. Thank you, Diana, for your preparation and sharing. I really do appreciate you. And we'll finish up today with just a couple of outro announcements. So please join us next month. If you liked today, meet us next month. We're going to be talking about federal, private, and prescription legislative changes that you need to know. We want to keep you informed of what these legislative changes will mean to you and your family. And Diana will be joining us again to discuss that. Here's other events you might be interested in this following week. So tomorrow we have HealthTree Moves chapter. That's kind of our fitness chapter. And myeloma patient Keith Guernsey is going to be coming to share his inspirational fitness and movement story about how to start slow but stay moving. Then on the 5th is our Southeast myeloma chapter. So if you live anywhere from Delaware all the way to Georgia, you're welcome to join us as Dr. Peter Voorhees is going to be sharing with us the best of ASH. He's going to be compiling his thoughts in each of the categories. What was significant about what was released for MGUS and smoldering patients, newly diagnosed, active myeloma, relapsed myeloma, maintenance therapy, stem cell transplant. And we are going to have your chance to ask your questions. So again, that's if you live from Delaware to Georgia, that's going to be our Southeast meeting. And then the 10th, if you live in Southern California, you're welcome to join us to talk about easy snack and meal ideas for busy patients and caregivers. The link to sign up for any of those events and even more events that I didn't mention are found at the bottom of the slide and will be included in that follow-up email that I've been discussing. Another thank you to Bristol Myers Squibb, GSK, Genentech, AbbVie, and Amgen for being our sponsors. And thank you to each of you for taking the time to be here. We hope you have a fabulous year and a great rest of your day. Thank you, everyone, and take care. Bye-bye.